This is the Bureau of Labor Statistics website on the CPI inflation rate, and I talk about this at least once a month. And let's just take some of the gradients of second derivative of inflation based on the CPI here. This is 2-month percentage change. It's already past its peak and falling back down to zero. So we are past the inflation spike in terms of the 2-month percentage change rate, and the 3-month percentage change rate is also past its peak and plunging. The 6-month percentage change rate is also past its peak and plunging. And the 1 year, the one that everyone looks at because the only unit of time that ever exists is 1 year, that is already flattening and it's about to plunge because all the others above it, 2-month, 3-month, and 6-month, are already plunging. So this is about to plunge as well. But they are reacting to this number being high for just a few months. Only for a few months, which is to say maybe 5 or 6 months, is their reading above 8%. That is causing the Federal Reserve to go from a 0% Fed funds rate to 4% and rising, while also not just stopping QE, but reversing QE, and thereby pushing the Wuxia shadow rate from what should be minus 4%. It was never as deep as minus 4%, but that would comprise full liquidity matching technological deflation, up to plus 4%. This is insane for them to react this late because all inflation measurements are already weakening. The internals of inflation, 2-month, 3-month, 6-month, as we saw, are all past their peak, and now they are raising interest rates in a rearview mirror point of view. These PhD economists at the Federal Reserve don't even know the difference between past and future. They are reacting to something that is already in the past. And their attempted method of reducing inflation is to eliminate jobs. They say we have to reduce 3 or 4 million jobs in the economy. They're deliberately trying to cause layoffs of 3 to 4 million people or more in their misguided attempt to halt inflation, which already is past its peak and has been for some months. Let's look at another inflation measurement, the Goldman Sachs Commodity Index. The Goldman Sachs Commodity Index is the most holistic measurement of inflation because it is worldwide and it cannot be rigged. It comprises of freely traded commodities, oil, gold, natural gas, silver, and so forth. There was a peak that was already about 6 months ago. So let's take this 1-year chart. This was the peak. The GSCI was above 800, but it's already fallen. It's down to 665. It is past its peak and has been for a few months, just like we saw with the CPI measurement in the Bureau of Labor Statistics. And at the 10-year chart, it's only a 0.62% growth rate. Effectively no movement for 10 years. How can you call this inflation, and how does this warrant such aggressive tightening by the central banks of the world, not just the U.S. Federal Reserve, but all the central banks of the world? They were doing quantitative easing for all of these years. The Fed funds rate was 0% for the vast majority of this period, and there was no inflation. So why would they react this way now, especially when it still isn't inflationary? There was a spike that ended 6 months ago, and it's already off quite a bit from there. Yet, this is the type of overreaction and trying to kill mosquitoes with a sledgehammer that the Federal Reserve is doing. They are so theoretical, they are so textbookish, they have no idea of the problem they're causing. It's just a video game to them because if millions of people's lives are damaged, they don't face any consequences, the people of the Federal Reserve. Their jobs are secure. They are immune to the economic cycles that they themselves create. How is that a fair system? So Goldman Sachs Commodity Index. And now one final measurement. Therefore, we are going to go to mortgage rates. This is the 30-year fixed rate mortgage rate. And for the first 8 years of the last 10-year period, meaning from 2013 to 2021, mortgage rates were pretty stable. There was no volatility in this market, thereby causing home prices to steadily rise but not to have too much volatility. Because the type of quantitative easing they do is very narrowly concentrated, the purchase of only treasuries and mortgage-backed securities, they pushed mortgage rates down to an unusually low level, 2.65% at its lowest point. Now, people who had bought homes before 2020, for them, this was fantastic. They had an existing amount of debt. They could refinance this down to a rate far lower than they ever thought they would see. But unfortunately, a lot of Americans cannot process a two-variable equation, and they think when interest rates are low, that is the time to buy a house. And they think they're paying less, but in fact, they're paying more. See this video up here in the upper right-hand corner to understand how this two-variable equation is too complicated for most Americans, and they end up buying when they should not be buying, and therefore are destined to negative equity because they are taking out a mortgage of greater dollar value even though the interest rate is lower. The way to make home equity gains is to buy when interest rates are higher, and then wait for interest rates to become lower and then refinance. That way you have both a lower mortgage balance and a lower interest rate. But in trapping a lot of people here, they have now forced mortgage rates to triple. We have gone from that 2.65% to now 6.95%, almost 7%. That is 3 times as much. On the same dollar amount, the payments would be about 3 times as much. And that destroys new demand for homes and therefore home prices. So a lot of people are going to go into negative equity. Anyone who bought after March of 2020 is going to be in negative equity for quite some time because they took out a much larger loan balance. And even if they locked in a lower rate, the loan balance and the value of that home is going to shrink and they're going to be in negative equity. If they took a variable rate or even a 3-1 or 5-1 mortgage, they're going to have a triple whammy in that sense, in that their payments will increase and their equity will be negative. And this is just like what happened in 2008, 2009, except then quantitative easing was new and was effective at rescuing people from their negative equity situation. Now, that method has been completely saturated because how much can they do in terms of buying the same two instruments, mortgage-backed securities and treasuries? They've distorted those markets and they have made the business model of major financial institutions nothing more than front-running the Federal Reserve. BlackRock buys individual single-family homes in order to front-run the Federal Reserve, which is what they have to do because there is nothing that is more of a direct guarantee of profit. Unfortunately, small-time investors and individuals cannot front-run the Federal Reserve as easily as a large institution like BlackRock or Goldman Sachs can, and this has therefore destroyed decision-making across the entire economy. So you have this type of extreme swing in mortgage rates, which is going to cause a housing bust. If you take this chart going back from the beginning of the 21st century to now, even in 2005, 6, 7, mortgage rates didn't rise that much. The lowering was artificially engineered by quantitative easing in order to create a recovery, but that housing bust was not even triggered by a sharp rise in mortgage rates, yet now we have something like this. And part of the problem is that these interest rates, they take 6 to 9 months to work their way through the economy. The Federal Reserve themselves says that. That is basic macroeconomic thought. Yet why are they raising interest rates this quickly when the impact of the rate hikes they did 3 and 4 months ago are yet to be felt? They're overshooting. That's why I say they're like a novice day trader. Why raise all the way up to 4% when the last 3 hikes are still too recent for their effects to be felt? When mortgage rates rise this much, it has no effect if it's this high for only a week or 2 weeks. But when it's this high for 6 months, 9 months, that's when you start to see a major cratering in the housing market and a major recession becomes inevitable as a result. So their increase in the Fed funds rate this quickly is almost as though they think that unless there's an immediate effect, then it had no effect. Even though they themselves say otherwise, how can they be acting this way? Now, cynics say that the Federal Reserve is deliberately trying to destroy the bottom 90% of people so that all wealth concentrates to the big institutions, which is not even the top 10% of people. That's less than the top 1% of people. I don't think that's true. I don't think they're that malevolent nor that competent. I think they just have a very textbookish theoretical outlook on things, and they believe that reducing employment by making millions of people lose their jobs is good because it will get rid of inflation that is already in decline long before their interest rate hikes, because they're that theoretical. And remember, a PhD economist is happiest when they are in a room with 5 other PhD economists who have all memorized the same things and they all recite the same memorized jargon back to each other. The thing they want the least is someone with a differing set of ideas or someone with data that proves their memorized textbooks wrong. Remember that. But this was a lot of charts and this is becoming a complicated video. But we are on the brink of a major economic crisis in a matter of a few months. It hasn't happened yet, but that's because these rate hikes have not been felt yet at all. This rise in mortgage rates is only in the last 2.5 months. Even August 18th was just 5.13%. 5.13 going to 7 has happened in the space of 9 or 10 weeks. It has to be high for 6 to 9 months for the effect to truly be felt. And that is what we're going to see as prior rate increases and quantitative tightening creates ripple effects that take 6 to 9 months to percolate. And it's a crisis that is entirely artificially created because of the incompetence of PhD economists and the outdated nature of macroeconomic thought, within the ivory tower of that establishment. I've said this many times on this channel, but a lot of people's lives are going to receive a lot of hardship, and it's entirely unnecessary. Yet this is what has been engineered, and we just have to watch and make sure we come out better on the other end. That's all we can do. Thank you very much for watching.